Hello everyone, Steve Lentz here with the Inside Wire here at Discover Options. It's April 3rd, 2018. Presented material today is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So folks, I've been thinking about this for quite a while now, and it's just been, one of those projects that's been, kind of gnaws at you a little bit that you have to get around to doing. And so what I did is a few years ago, I had this engine built in Metastock, and it was called Statistical Edge Analysis. And we used this approach to evaluate credit spreads, the viability of credit spreads in pretty much any options market using a given technical analysis signal. All right, so I'm going to show you, we will review that a little bit. Then I'm going to show you a new approach that we'll use moving forward that'll become part of the likelihood report that I do every weekend. And moving forward, it could be used for a number of things, and I hope you'll appreciate what I came up with here. It's been my last week or two, about the last 2 weeks, I've been working real hard at it and building a whole new set of interweaving formulas within Metastock. So let's go to it. Let's review what we were doing before on statistical edge analysis. Is we were basically looking at a given close, say from a technical signal, and we were then putting these bands. In this case, we have 10-day statistical volatility bands here. These are 10-day bands moving forward. And what we were doing is just measuring after a given signal, like for a bullish, if we were expecting the market to go up, we would want to sell premium underneath the lower band. And on bearish signals, we would sell premium above the upper band. And so the question was, after signal, how less often, let's say in a bullish situation, we want to know if there's an edge to selling premium down here in terms of how less often that band gets hit after our given signal. Because if a signal fires and it is actually, has some, validity to it, let's say it's a bullish signal, well, then the lower band should historically, on that signal, on the past occurrences of that signal, that lower band should get struck less often than, say, just the random, historical benchmark looking at every close going back for any given asset. Likewise, on a bearish signal, we would expect that the upper band up here, historically would get struck less often on the history of those when that given signal is fired. So how less often is the upper band struck? And we came up then with these various reports. And here's the market likelihood report where I use the upper and lower bands just to determine, in this case, we're just looking at the likelihood of the market moving and hitting those bands more or less often. And so that's the technology that I used and I'm still using to determine likelihood of a given market, condition, for the future market going up, down, or wobbling around for a bit. But what we need really, and I'm finding a disconnect here. This isn't really catching on. I don't see people asking any questions about it. Every weekend we do get a number of viewers on our presentations. But what I wanted to do was find a better way of documenting and quantifying the likely direction and volatility of the market based upon past occurrences of the same market condition that we have going on. A better way of documenting and communicating two things: direction, likely direction, and then the likely volatility level. So here are two things that we're going to take a look at, and that is historical data of the following two items, and this is in terms of a percent. The average rate of change over the last, over 5, 10, and 15 days. So when a signal fires, okay, or when a market condition fires today, and we go back and look at say the last 50 times that same condition has fired in the past. We're going to look at the rate of change over the subsequent 5, 10, and 15 days in terms of a percent, the rate of change close to close. I'll explain that in a little bit. And the other thing is to look at the standard deviation of those time periods moving forward. So let's take an example here. Let me just explain rate of change. So this is within the Metastock program, and I am using the Metastock's formula, or the function, the built-in function, the price rate of change indicator, and you can have it set to percent. Okay, you divide the price change over the last X periods, and I'm using 5, 10, and 15, by the closing price of the instrument X periods ago. Okay, it's real simple. I'm looking at the close of 5 periods ago, 10, and then 15. In this case, I'm going to show you how we actually move it into the future. So let me show you how this works. So here is the Metastock's price ROC, the rate of change. And in this case, you can see here with the price here roughly around what, 2147 or whatever it is. If we were to go back 5 days, okay, 1, 2, 3, 4, 5, we're up here. The market has dropped, pretty substantially, well over 1%. And that's what you're seeing right here. It's a negative over 1% there. And this is in percentages. Okay. Now, what we're going to do, and what we're, for our purposes, we really want to know for a given bar, after a signal has fired, and let's say that this signal is the one firing, we want to know how much the price changes over the subsequent 5 days. 1, 2, 3, 4, 5. Okay? So that's what we're doing here, is we're taking a given signal and going forward. So here we have, when we go and look at how much the market has gone up, 1, 2, 3, 4, 5, okay? Let me see, does it go in? Yeah. When we look at the rate of change, we could see down here, well, it's actually going up over 1%. And that's why you could see here it's up over 1%. But what we're going to do is create an indicator that backs this up and shows that for this given bar, the forward rate of change, and I created my own indicator and coded it and all that stuff. In this case is well over 1%, about 1.5% that you can see there. Okay, so we're measuring the rate of change going forward. The actual software, has it reported, from 5 days ago to present. We're going to go from today moving forward and report that level. Okie dokie. So with that said, let's now just take, and I created a little spreadsheet so you can clearly see how it is we do this, where we take the 5-day rate of change and then I create a percentage based on that. Okay, and that's kind of just, and I'm looking at basically the 5-day change. You take a close 5 days ago to the close today, and then you back into that 5-day change, and then I'm just converting it to a percentage. And that's what we have down here on the 22nd. It's at 1.37. Okay, and again, you can see 1.37 here is there, and that corresponds accordingly there. Okay. All right, so now let's go look at standard deviation. So we have rate of change. Let's look at the standard deviation. Now, and this measures volatility. So standard deviation is the statistical measurement of volatility. It is derived by calculating an X time period simple moving average of the data item, and we're using closing price. Okay, and then it goes through the concept behind standard deviation, summing the squares of the difference between the data item and its moving average over each of the preceding. I mean, this your eyes glaze over, all right, to come up with this. And if you want, you could go back and look at my February 12th, 2012 presentation on Bollinger Bands, Part 3. And what I do there is I go through this whole process of taking, and it involves square roots, and you know, and it's quite the process to get a standard deviation. And I have a spreadsheet in there. I fully explain it. Here I use an example of the heights of dogs, and it really kind of encapsulates why you go through this huge process of using square roots and etc. Okay, so just watch that presentation if you want to get a handle on what standard deviation is. But basically, we have the standard deviation reported down here, and this is the metastock formula or function built in. But again, we're looking at the standard deviation moving forward. This is reporting on what the standard deviation is for the past. So we're going to go forward 5 days, and we can see here that it's well over. Standard deviation is 15. Now, here's one of the issues: is that the metastock standard deviation is reported always in terms of the actual points, not in terms of percentage. So what I'm doing is I'm walking through this, and let me just show you kind of how this works. 1, 2, 3, 4, 5. So what we're doing is, let's see, 19, 20, 21. So we're taking, this is 5 days later, and basically standard deviation is taking the difference between, and let me just switch colors quick, the moving average at this point, and it's taking a look at then the difference between the closes and that moving average at that point right there, okay? And it's looking at those differences and walking through that process, but it expresses it always in terms of the actual points. In this case, you're going to have 10 points, 15, 20 points, etc. And we really want to back that into a percentage, okay? Something we really want to do. And so here's what we did. I'm walking you through the process, and I have this in that February 12th, 2012 presentation where we look at the closes, we take the 5-day average, and then we take the difference for each of the last 5 days and this particular day's average, get the sum of the deviations, sums of the square deviations, and all this, get the average. That gives you your standard deviation, and then we're going to back into the actual percentage. The percentage, and that's important because we want to be able to take this method and apply it to all kinds of different assets, and not just a single underlying asset. Okay? So we have rate of change and standard deviation now, and so here's what we look at from yesterday. If we were to take yesterday's market condition, and here's where I'm going towards my market likelihood report. When we look at the market condition, and I always express it in terms of at least 3 dimensions: price action, trend, and then the stochastics situation. This time, because we have such a large bar, I'm throwing in an average true range percent as well. But in this case, we can see that we have an upswing bar followed by a downswing bar. That's price action. That action, and an upswing being higher high, higher low, and then a lower low, lower high, upswing, then a downswing. That occurred while we are below the 50-day simple moving average. Okay, and then in terms of the stochastic, we are in the oversold level between 0 and 30, trending underneath our moving average, technically, if you were to blow that up. Now, additionally, I threw in the price action of the fact that we have a very large bar here that's well over a 1% average true range for that given day. All this makes for a market condition that's only occurred roughly, I'm going to say, 29 times since Jan of 2000. 29 times since Jan of 2000. Now, and I can go, in my Metastock program, I can go back and I dial in that exact market condition. I go back and can view all 29 occurrences in the past. And what I'm going to do is look at each one of those in terms of how much the market moved over the subsequent 5, 10, and 15 days. And I'm going to get the average level of change over the subsequent 5, 10, and 15 days. And then I'm going to determine the standard deviation for the following 5, 10, and 15 days on average for all 29 of these similar occurrences. And so Shazam, here we have the magical report, which I found quite surprising. So when you look at this, okay, since Jan of 2000, we've had 4,573 occurrences for a closing bar. And this is the benchmark, okay? Obviously we've had a big bullish run since Jan of 2000, all in all. On average, the market changes 0.1% to the upside every 5 days. A 5-day rate of change from a given close 5 days in the future. On average, you're looking at a 0.1% to the upside, bullish. If you were to go forward 2 weeks or 10 bars, 10 days, the average 10-day or 10-bar change is almost 1/5 of a percent, 0.19. The 3-week change is not quite 1/3; it's at 0.29 of a percent. Now, the standard deviation there, when you look at those 5 occurrences for the 5-day change, what the standard deviation is for those each on average for a 5-day look forward is 0.81 of a percent. The 2-week is at 1.15%, and the 3-week standard deviation is at 1.39. Okay, so this is the benchmark. This is on average for the market going over 4,573 occurrences. Now, when we look at the 29 occurrences of our current market condition, and we look at the average 5-day change, look at this. It's at 0.88 of a percent, substantially more than the benchmark of 0.1. So this is quite bullish. Okay, this is coming off of yesterday's close, just looking forward 5 days. There's no guarantees, certainly, but when you're looking at the past, at these other 29 occurrences of this market condition, this is quite interesting. The 2-week changes, look at this, is less than that, 0.57. Wow. The 3-week change goes up a little bit from that to 0.76. Now, I wish we had more than just 29 occurrences, but we don't. But we're going to report this anyway. It's just interesting how you have. I mean, usually you have a progression here. Low to high, like we have here. 0.1, 0.19, 0.29. Okay, but here it kind of starts high, goes lower, then comes back up, which is interesting. The standard deviation ascends. 5-day is quite a bit more than the benchmark at 1.18, 1.65, and 1.9, almost 2% standard deviation at the 15-day level coming from our market condition here. Okay, so this is quite bullish when you look at the past, but we also can see that the volatility is quite a bit more. So what would you conclude here if you were to pick a likely direction? All right, if the past has anything to play into us, you would look at a 5-day change to be quite bullish. 5, 10, and 15, looking at the past, this would indicate that this particular market condition leads to bullish behavior, typically. But it also leads to more market volatility by quite a bit as well. Now, this is the first week I'm into this. I still have other little tests to run, and I'm other ideas. And if you want to send me your ideas, I'd certainly appreciate it. But I'm finding this to be very interesting, and we'll find out truly if it's helpful. I'm interested in evaluating particular technical signals and looking at them from the concept of a 5, 10, and 15-day average rate of change, and then the standard deviation as well for purposes of premium selling, either bull put spreads, bear call spreads, or butterflies, etc. Okay? And now what did I have here? Oh, and I also threw in the notion here, you find this interesting, of these 29 occurrences, there were some where the market exceeded the previous day's high. So for example, if today price goes above the high of yesterday, what does that mean for us? Well, here you can see that the 5-day change is 1.5, 2.72, 3.41%. Pretty substantial to the upside, but that only occurred 4 times. More often than not, of those 29, you had 26 occurrences where price went down below the low of the previous day. That would be the low of yesterday in our situation. And even then, even after going below the previous day's low, when you look 5 days from now, you have an average 5-day change of over 0.5%, 0.65, 0.42, and then 0.51. And in all cases, the standard deviations are much greater than the benchmark. Okay, so that's kind of where we're headed here in terms of evaluating signals and market conditions for premium selling. It's a different format. I hope it's more, it connects more with the trader. I think it will, because we're giving specific directional likelihood and specific volatility likelihood as well. It's more defined, and that's what I like about this. All right, anything from you guys? Steve, I could send you some feedback suggestions via email. I am very interested, Brian. Please, that would be wonderful. Absolutely, that would be great. Thank you very much. Okay. All right, folks, thanks so much for joining us. We'll be back next week with another topic. Please send me your email and suggestions. I'm always all ears. Thank you. Bye-bye.